Thank you for joining iMeet. When you hear the tone, you will be the 15th person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. We have a lot to go over today, so I'm going to try to jump right into it. But if this is your first time joining us, what we generally do is talk about 20 or 25 minutes. We try to go over what happened in the market last week, and we try to look at some areas of the market where we think we can make some money. At the end of me talking about 20 or 25 minutes, we'll open it up to questions. You can ask anything about individual stocks, industries, targets, anything else you want to talk about with the market. But we're going to go ahead and jump right into it because, like I said, we have a lot of stuff that I wanted to go over today. All right, last week we took a look at all the negative divergence that was showing up in the different indexes. We pointed out some support levels that you wanted to keep an eye on if the market would begin to sell off. And with Murphy's Law, the next day, Janet Yellen came in, opened her mid-year testimony on Capitol Hill, and she set off a three-day rally that left the different indexes on Friday all in record territory except for the NASDAQ. So we had the Dow Jones, the S&P 500, NYSE, the Transportation Index, Russell 2000, all closed at all-time highs. And that was actually the best weekly performance for the market since about late to mid-May. Okay, the CTI is a -4. It's expected to be a -4 again this week. What that means is historically that's been the market's been susceptible to downward action during that time period. We're expected to be at a negative reading for probably the next maybe 2 or 3 weeks. Momentum index actually improved last week. It moved up to a -1 on Friday. The reason that's a negative number is it means that the Dow Jones is still outperforming most of the other indexes at this stage. Sentiment is still also neutral. We're at a +1, not much action there. We saw a little bit of a pullback in the number of bulls last week, which would be expected. We could see that pick up here tomorrow when those numbers come out. We'll have to see. So quickly, while the CTI has been negative over the last couple of weeks, the market had basically traded kind of sideways during that time period. As you can see, you grab my little arrow here. You see this area here. I think we went to negative on the CTI right around in here, and we've been kind of mixed trading through there. And here's last Wednesday where Yellen came out. Here was the negative divergence that we were talking about last week, coming out here where we're pushing new highs and things were starting to roll over a little bit. Even the advanced decline line had weakened a little bit, but a lot of improvement over a 3 or 4 day period, including strengthening the indexes. The strengtheners we publish on Fridays, they also moved up for the first time in about 6 weeks. That showed that there was buying pressure that was increasing on the different indexes. So anyway, so we come up here with Yellen on Wednesday and Thursday. She's more dovish than traders expected. She's looking at some of the weakening economic data, and she decides with her testimony that rates may not change and it may be pushed out until at least December, possibly longer if needed. We'll have to see about that. That took the 10-year Treasury yield down from about, I think it had moved up to about a 2.45 or something. Going into that, we're back down now to about a 2.31. Today, actually, we're down to a 2.26, which is hurting the banks even more. We'll go over that in a little bit. But as you can see, as the 10-year Treasury goes lower, or actually the yield goes lower, that causes a flattening in the yield curve, which cuts into the banks and into their profits. That's why you're starting to see a little bit of profit taking as they're coming out with their earnings. So we get back to a slow but growing economy with ultra low rates, which is going to probably limit the downside in the market going forward for a little while here. I think the bigger risk goes back to being geopolitical risk from North Korea or something like that, or terrorist attacks. And we're back into an accommodative monetary policy. We'll see how long the data supports that, because looks like the Federal Reserve is going to be even more data dependent to see, we recently had some weak reports. They want to make sure that's just not seasonal, and not, just the whole economy slowing down. And lastly, I just want to point out that, in my opinion anyway, I think if Yellen has an eye on the exit door, I think it's probably highly unlikely that she does anything that's going to cause a market correction in here. She just want to leave office with her legacy, being that she, caused the last big correction in the stock market. She's done a pretty good job as far as keeping a floor into the market. I imagine that she's probably not going to want to nudge rates too high going into the fall, especially if she's about ready to be replaced. So I think we've got a pretty good environment still in the market. It's still not cheap, but I think we're back again to where else are you going to go. So we're going to look at a few charts in the major averages, and then I want to give you something to keep an eye on that needs to be watched on your own charts that you keep with yourself. And there's always something that we need to keep an eye on. But first, here's the Dow Jones. As you can see here, where we were pre-Yellen speak, we were going sideways over here. We thought we may get a little test down here to the 50-day moving average. Never even got down to that, and now we're up here to new highs, which we hit on Friday. We're still cautious a little bit just because of the negative CTI, but I don't think we're going to get that pullback down to this area. I think that we have a target right now. If you follow this upward channel, if we get back to the top of that channel, that's going to put us somewhere around 21,835 for the upside target at this stage. I think possibly we could hit that over the next few weeks. We also are getting we talked about this, where we're starting to get a little bit of turnaround last week on the AD line, where we thought this would come back down to about here. That would be negative, and we could induce some more selling. Turned around on her testimony, and we broke out. We actually picked up 3,182 units last week. What that means is AD line is a running total of, you just take the number of advancing units, the number of declining units, subtract them, and you come up with this running total. And we're up here pushing a new all-time high. This is generally considered a leading indicator if you're new with us, and that's something that this isn't really giving us any fear right now. That's one of the reasons why you're seeing the VIX down here at, I think they said the other day that the VIX had gotten down to where it was in 1993 or something was the last time we saw that. I'm not going to go over the S&P because it looks basically like the Dow Jones. Okay, here's the NASDAQ. We're almost pushing that old high. The old high was 63.21. We're at 63.28 right now. So we are punching out a new high today. So we're up in here. That's bullish. We've talked about this mini break over here where we started in June, where we had a little bit of a correction, bounced off the 50, then we broke down through it. This is where we were last week, and we were saying we could get some downward pressure onto this thing, maybe down to the 100-day. But with Yellen's testimony, that picked up, and you see the improvement and the bullishness in the different indicators, even the advanced decline lines going up, and we're back above that 50 and actually back above 80 on the 30-day stochastic, which I like, which means the trend is strong again. Okay, let me point something out, because I had some questions about the negative CTI and where that would leave us. Our market posture is neutral rather than bearish, and I said that's due mainly because of the strength in the momentum indicator. And we talked last week that we actually could technically or theoretically stay neutral for the whole cycle, which would keep us neutral even though the market's breaking out into new highs. How much more upside we're going to see is debatable. But what the CTI means when it's negative is historically there's been a slowdown possibly at this stage of the business cycle. And like I said, last week we had a little bit of it, and they were a little bit worried about rates going up, but it turned around when as soon as Yellen said that we're going to leave rates low for longer than people probably expect. That's where we got this pop right here. So this stage, I think we can probably get a higher move in the NASDAQ, probably up to around the 64.50 area. And again, the negative divergence that we saw, the breaking down the indicators, turned around in the last couple of days, and this is back to going bullish. And we talked also with a bearish sign would be when the 14-day RSI breaks below 40. We didn't get that. We got down here about 40 plus, and we turned around, so that the bullish trend was still intact at that stage. We were oversold in the 30-day, which meant that the trend was actually starting to gain some momentum. But now we flipped that back above 80 already, so that means that this trend is still strong on the Nasdaq here. Again, we looked at this chart last week. Here's the Nasdaq AD line. We thought if we broke over here and would go down to this 316 area, that would be a negative. It might induce some more selling. It didn't. We got, as soon as she spoke, we got the pop up to here to a breakout a little bit to the upside. We actually picked up about, I think we picked up about 1,500 units last week on the Nasdaq AD line, which is healthy also. So this is supportive of higher prices also. So we'll, I think we're going to probably move a little bit higher here. The Dow Jones Transportation Index, we actually got another, it's played some catch-up ball here. It's been on fire since bouncing off the 200-day back in at the end of May. It's been going straight up like this. We broke out of this to a new high over here. It confirmed the Dow theory buy signal. You can read about that, which just confirms that when the Dow Jones breaks out, you want to make, you want to see the Dow Jones Transportation Index support that, because that means that not only are we making goods, we're transporting the goods too. You can read about that, or we can go over that some other time on one of our webinars. But that looks good. That should keep the rally intact. The fact that the transports are making new highs. It's had a little bit of weakness here the last day or two, but I think as long as we stay above this 9,600, I don't see much breaking down. It could actually get down to about 95 before you're going to start having a little bit of a little worry. Here's that negative divergence that we were talking about. That seems to be breaking on. This isn't, it's not as strong as some of the other ones, but I don't see any problems with the transports, rearing its head, doing anything else. Now here's the Russell 2000. We broke out of this. I meant to put up the point and figure chart on this. I didn't get a chance to do it. Maybe we'll do it at the end. You can see where we probably broke out at least maybe a quadruple top in the point and figure. Broke out of here, not real strong yet, but today we're down a little bit again today, so we're kind of bouncing off of this little, with resistance is now support. So we're kind of holding on to that, and this is still kind of neutral and not really a negative divergence, but we're seeing a little bit of a pickup in the 30-day, and we're back above 80, which is good. I would like to see this thing get up to about the 1442 area. That's our next target for the upside on that. So as far as looking at the different indexes, we saw a lot of improvement over the last week. Now we want to take a look real quickly to see what sectors we may want to go into now that we've had this little change in the outlook for rates and all that. So what we're going to do is just kind of see what worked out last week, what moved off of this from last week as far as after Yellen talked. Okay, the best performing sectors over the last 1 week period since the end of last Tuesday. We had technology, as the XLK was up almost 2.5%. Consumer discretionary up 1.63. Utilities 1.5. Consumer staples 1.48. Materials up 1.3, and energy up 1.05. Now, utilities and consumer staples, a lot of that is going to be, if you got to find yield somewhere. You're going to go into the utilities and consumer staples. These aren't going to be my favorite sectors, as you'll see going forward here, but we're going to look at each one of these individually quickly and just to see where we think we can go. All right, here's a look at the tech sector. As you can see, we had this breakdown over here. We found support down here around the 100. Didn't even get down that far, but we did get down to the lows back here in mid-May. Found support at that low, and now we've bounced off and broke through this descending trend line. We're up here at this first resistance point, but we're moving higher today. I believe, let me take a look real quick. That's a little bit higher today. What's hurting the Dow today is Goldman Sachs. This broke back above the 50-day moving average. We see the turnaround here in the different indicators. You'll probably see the 14-day RSI break out up this way today because we're making a new high. We want to see that move higher. We're also going to take a look at what industries here in these different sectors again today are leading. You know, you just don't throw everything into one industry when you see this. It could be something else that's leading it this time around. This was all semiconductors. This actually turns out to be a little bit something else that we're going to look at. Okay, the next one over here. Consumer discretionary. Again, not one of my favorite sectors, but it's you know, we were breaking down again over here. We found support at the 100-day moving average. Now we've come up and we've been able to clear the 50-day, which is a positive. What you like in this is the specialty retailers. You know, the box stores have blown up. We're going to look at a couple of different industries on that, but the fact that you know, we'll look at what industries in the consumer discretionary group are outperforming in here. But again, you're seeing this pick up here. We never got down to broke below 40 on the 14-day RSI. That's a positive, and now we're breaking above the 50 line on the 30-day stochastic, which means now we're getting another bullish trend on that. Okay, utilities. We had rolled over on that. We were lucky again to find support on the 100-day moving average. We're bounced off of that. We're bumping up here against the 50-day. I don't know that there's a lot of upside potential in this, where we're going to break out the new highs, mainly because I think you might get up to this old trend line. We might get up to that area, then probably kind of maybe go sideways. Part of that is because the utilities aren't cheap still, and but I think this little bounce here is basically just people looking for a little bit more yield. You don't want to. You know, it's still more than the money markets. And if you're happy with a 4 or 5% yield, which isn't bad, you know, why not go back into utilities until maybe October, November. Here's the consumer staples. Again, we had to break down in that. Broke down through the 100, all the negative divergence that we talked about. Again, we got a bounce, not near as much as what some of the other sectors are doing. And you're also not seeing the accumulation distribution here. I believe this little bounce here is probably, again, due to the yield that you're going to get with something like a Procter & Gamble and Colgate, those kind of things. So this isn't an area that I want to chase in this. If you're looking for some yield, maybe you buy the stocks in here that are outperforming. You look at the relative strength, the 50-day RS on our Market Edge program, and see if you can find some consumer staple stocks that are trading above 1, which means they're outperforming the S&P 500. Okay, we go over here to materials, and this one I do like for several reasons. You want to go into this group. We were trying to range bound even when the other sectors were starting to roll over. This thing held up above the 50, looked good, and we got a nice little move in there. Part of this is because when you have a weaker dollar, which we're going to look at, it helps the energy sector. It also helps the materials. The fact that the rates are going to stay lower than maybe possibly some other countries, that means the materials should outperform. You can see the turnaround here in the different indicators. We're going to go in here in a minute and look at some of the point and figure breakouts and some of the point and figure alerts to see what stocks and what industries are in the materials sector that we want to put some money to it. Even on the this, you're starting to see a little bit of a pickup on the advanced decline line. If you go into the Market Edge charts and look at the 50-day up-down slope, you'll see even more of a accumulation showing up there. So this is an area that we want to go into. Infrastructure stocks would be included in some of these. Part of that is because some of the metal stocks, things like that, gold, silver. Part of that is with this rolling over maybe a little bit of the healthcare stock. And now we're looking maybe Trump may have to focus maybe more on building out the infrastructure. That may be where he would make some progress. All right, the next one here we want to look at. This is surprising. I haven't liked this for a long time. We recommended shorting, up here when it gets up to this line. I think things may be a little bit different now. We went up yesterday to the 50-day moving average on energy, which has, mostly oil-related type stocks. We're starting to see a little bit of a pickup here, a little bit of positive divergence in some of these. We just actually cracked above the 50-day here. I want you to keep an eye on this. You can always draw trend lines on indicators. And if we see this on the up-down slope on the market edge chart, or this is the stock chart, so you can look at break above this downward slope, that means we're starting to see accumulation in energy. I think, you know, with the lower dollar, I think we have a chance here where we may get a break to the upside on some of these oil-related stocks. For the first time in a long time, I think we can, you know, make some money on some of these things. I don't know that you want to hold these things for, you know, 6 months to a year, but whether we get a 2 or 3 months trade out of energy, it may be time to look at that. We'll probably go more into this next week as we watch what oil is doing. Oil today is back up. We're at 46.30. You know, it's going to struggle at 48 to 50. That area is where we're going to struggle. Not on this chart, but on the crude oil when we talk about that. And we'll have to see what it does. But right now, I'm starting to see some underlying hints that this may be something where we could finally get a little bit of action in this. I'm not saying go out and buy them right now today. I would rather wait and see this thing go above the 50. But if we go into the industry group and look at some of the different oil field drilling and some of those stocks, there's some charts that are also looking pretty good that we can look at. Okay, this is the healthcare sector. We like that. You know, we had a throw over here. We had another throw over here. Came back down here to the pivot point. We're we had a little bit of a problem here. This isn't really due. This negative divergence isn't really something I'm worried about. The thing breaking down. This is basically with all this stuff with the Healthcare Act. What was going to happen? The market doesn't like the unknown. They didn't know. If you don't know this Healthcare Act is going to pass, what's going to be in it, you're going to hesitate on here, and that's what we did. So you may have a little bit of an uptick now in the different, you know, back in the biotechs and pharmaceuticals and some of the healthcare, health devices, that kind of thing. You may get a little bit more of a run in that thing again. If you can see this channel, see this thing start to move up above that, and start to see more of a turnover on these indicators, it should be good. And we talked about IBB, which is the iShares NASDAQ Biotech ETF. We wanted to see this thing break above 300, and we finally got it here. A couple weeks ago, we bounced off the 100-day and the 50-day, had to break out, came back down 305 or so is the pivot line. We're up 0.25% today. Pharmaceuticals are up a little bit today, even with the Dow down, 86 points in here. So I think this ran up, had a little bit of pullback on, overbought, and now you can see over here the overbought area. Coming back over here 60, we may work our way a little bit higher on that. So with the biotechs, I've suggested for a long time that you want to buy a couple of these. They're still under good accumulation down here. With the biotechs, you don't want to put everything in one biotech. You want to own like 4 of them. A lot of M&A activity still going on in this group. It's still cheaper for a Merck or Pfizer to buy a biotech that's come up with a new drug than to put resources into developing it on their own. So whether you get a small company that discovers a new cancer drug that triples, or whether it just gets bought out, you want to have a biotech exposure in your portfolio. Okay, now we're going to look at financials. As you can see, this thing's been working its way up. Okay, from right around here, we're going to raise rates, we're going to raise rates, we're going to raise rates. We're not going to raise rates. What's that going to do? Okay, that caused this to sell off a little bit, and now you're seeing this yield curve once again starting to back up. Like I said, we're at 226, down from like 245 or something here just a week ago. That's going to cut it on the banks. The banks, they're reporting great earnings. That's great. However, the yield curve will cause the banks to, they may not be able to have this breakout like we were hoping we might get. I probably would not be taking profits in the banks here unless you've bought big positions for maybe an earnings pop. Maybe you sell half that position and then you wait for a pullback. And I would buy the pullbacks down to the 100-day moving average, or at least if things would pick up a little bit on the downside, at least down here the 200-day, because I think you want to own these going forward, once rates do begin to pick up. And, if economic activity starts to pick up again in October, whatever, and they start to talk about raising rates again, you'll see this group hit up. So, again, not something that you want to chase in here just because they're coming out with good earnings. I think that price action has been built in to these earnings. Everyone was expecting them to make a lot of money this quarter. They did. but you saw a lot of, that they didn't beat was as far as interest income and also in their trading income, because you're having, they didn't have the volatility in the markets. When you don't have that volatility, they're not getting the big swings where they can short and go long the market, like they normally would. Okay, last one here I want to look at is REITs. Again, you saw this thing with when higher rates is not good for REITs. I thought we would get a little bit more of a move. It rolled over, but now we're getting a pickup in this thing. We broke back above the 50-day. That rates are going to be a lot lower for longer. That's good for the REITs. Now, when you look at, if you're going to put some of this, if you're looking for yield, number one, I think you're going to get a second wind in this. You could probably get up here at least to the old highs and maybe go sideways up in this area. But you don't want to look at this and go, oh, well, here's a REIT that's paying 8%, here's one that's paying 10%. Those aren't the ones you want to buy. You want to buy the REITs that are probably paying 4%, 5%, something like that. The ones that are paying 8 and 9% most likely are going to, they own the wrong real estate. They may be in malls, shopping malls, things like that. They may be in, buying Detroit or something like that, where the land's not really going to appreciate. So you want to buy, if you look at whether you buy an ETF or you go into something like Nally Industries or Post Properties or something like that, when you look at an ETF that you want to buy, you want to make sure that it has a 50-day relative strength above 1. You want that REIT to be outperforming the S&P 500. That's going to be one of your first hints that they have good properties that are in their portfolio. You're not going to get beat up with them saying, well, we're going to close the Southern Park Mall in Youngstown and we're going to have to cut our dividends, which causes the thing to roll over. So don't try to be a hero and go for the big yields on the REITs, but if you find one that's paying like 4 and 5% that's outperforming the market, that's where you want to be. All right, now I want to go here. I'm trying to wrap this up pretty quick. All right, we saw the bounce of the technology. If you go to the industry group, you go to all groups, you can by hopping on these things, you can figure out what outperformed of the 1 week, 4 weeks, or the 50-day relative strength. The first chart we're going to look at here is what performed over 1 week. By that, I want to see once Yellen spoke, what industries outperformed, which ones jumped. So we had internet content up here jumped 6.6%, oil field drilling, diversified mining, materials. So now we have the technology, we have energy, we have materials. Aluminum was up 5.5%. You did have semiconductors bounce back with the NVIDIAs and the Cypress and that kind of thing. They were up 5% last week. The next one down here, oil field equipment. Again, the energy sector. And when you get these moves, 5 and 6%, this wasn't mom and pop, buying 100 shares in their, Schwab and TD account. This is institutional money. Something changed. Yellen changed the ball game. Rates are low. The dollar's going to come down. This is going to be good for some of these sectors. That's what moves these things 4 and 5%. You go on down there, you had metals, non-ferrous. Then you had internet retail, precious metals, software, paper products, and steel, and forest products. All these top industries over the last week, these are what we just talked about as far as the energy and the materials and the technology sectors that we want to be in. Go a little bit further, internet software, chemicals. So, again, just what we talked about, where you want to be going, that just happens to be the industries that are performing. All right, so now I want to go over and take a look, if we're going to look for some stocks in those different industries, not only can you click on let me go back a page. Not only can you click on these industry groups, you'll get a list of stocks. You want to find the ones that are rated long with a 0, possibly even a -1 since there's been some deterioration. Now, the fact that this says the condition was deteriorating, it was. We saw that before. Since June, the technology sector has been deteriorating. However, you can't say this will change probably pretty quick to improving when you have a 6% move like that. Okay, so now if you go over, you're looking for some stocks that maybe broke out yesterday. If you go over here to the point and figure breakouts under advanced tools, this will give you a list of all the stocks that broke out yesterday. In this case, we had, if you all take this by power rating, and you'll get, Lakeland Industries, Parker Hannifin, Commvault Systems, here's Vornado Realty Trust. That would probably be a REIT, broke out of a double top. That may be one you want to look at for that. Here's Royal Gold down here, Ultratech ProShares. Some of the sectors that we talked about. What you want to look in here is when you find these stocks breaking out, you want to see if they're in the leading sectors or the leading industries. Okay, another one we can look at, and one of my favorite places to buy to look at some stocks I want to buy. If you go into point and figure early alert buy signals, then click on the power button over here. I want to get the ones with the highest power rating. Those are going to be, usually outperforming the market. Again, we can go in there. Here's AGIO. It's going to break out of a double top if it trades at 60. This will tell you the price at the breakout price over here. But we want to look to see if there's any mining stocks or gold stocks or biotechs. If they're showing up over here, these would be some stocks that we can look at the chart and see what these are all going to be rated long. The score is probably going to be 0 on this. You can see what formation they're breaking out of. So that'll give us an idea of some of the stocks we want to pick up. Okay, I'm going to get to your questions in just 1 minute. I'm starting to see them come on. So if you want to go in here and start putting your questions up there, we'll have a little bit of time to get to them. But this was kind of a long session. All right, what I want you to keep an eye on and keep this chart. You can make it yourself and kind of keep an eye on this thing, whether it's daily or long term. This is UUP. It's an ETF. It's a U.S. dollar. As you can see, this thing coming down for the last year. Surprisingly, you weren't seeing this thing, a little bit of bouncing up in this descending trend line, but this wasn't showing a sign of strength. As you can see, the negative, confirming that this thing may work its way a little bit lower. I don't know if I mentioned this last week. I believe that we'll probably get down here to the 200-week moving average, right around $24 on this UUP. I'm not sure where that translates with the actual dollar, but if we find support down in this area, that's where I think you might be able to get a little bit of a bounce. But this to me is showing that there's two things. If the dollar continues to weaken, it's going to cause inflation to go up, because it's going to cause some of the commodities, will cause oil to go up, some of the materials, and that could surprise everybody with a little bit of showing inflation. But this may be thinking since the first of the year, as this thing's working down, perhaps it's a sign that maybe investors are thinking that Trump trade may not get going like they thought it was going to. It may also be a sign that investors are losing confidence in the economy. Whatever, but this isn't a chart of strength. And again, this is the weekly chart. But with that in mind, you want to find when the dollar is getting weaker, what is going to what benefits from that. And some of that is like I say, it's materials, energy, technology usually does good with the dollar still going down. And and we want to look at gold here real quickly. I had somebody ask about this. Here is this is the gold and silver index. You can see the descending trend line. We're up here right now. We've gotten a bounce off of this area down here, and we've come up to the 50-day moving average where we're kind of struggling. Gold's been up about the last 3 or 4 days. It's up today about $8 at $12.42. Watch this descending trend line. If we can break above this, we're already right here above the pivot line, which means as far as traders go, they're looking to go long at right here. You're seeing some positive momentum in that. You also have the 30-day stochastic break above the 50-day. Now here's the 50 level. Now here, lastly, is the gold index, and you can see this the range bound that we've been in. Again, okay, over here we bounced off of these lows from back in I want to say that's maybe March or something like that. As long as it holds above this, we went above the 200-day here. Here's the 50 coming down below the 100. We could probably run up here, maybe this 1247 area. We're at 1241 right now, which is right in here. And I think that, like I say, our next resistance is going to be 1247, 1248, which is about another $10 on gold. We get above that, maybe we make a run back up here in the 1280, 1290. We'll have to see on that. This isn't an all-in trade by any means, but you can see the improvement in the different indicators. You have the 14-day RSI coming up here over the 50. It's probably above 50 now because it's since I put this chart in, we've gone a little bit higher. You can also see over here where we're starting to sell off. You want to see if the accumulation distribution lines can get back above this line over here. There's probably a good chance that we can. Gold is oversold in here, but I think if we see gold break above this 1250 area, 1260 area, you can probably get a pretty decent move in that. So there's maybe a little bit of time for people to buy some of these assets that we haven't been real bullish on, but doesn't mean we're going completely conservative by any means, because I still think the healthcare and technology and some of these others can still move higher. Okay, that's all I got for you today. We got a couple questions coming in there. If you have any other things, we don't get them to them today, feel free to email me at thedoc@marketedge.com or support@marketedge.com. First question we have up here would be, how should we think about it when something with relative strength gets greater than 1 has condition deteriorating? All right. Good question, Linda. That's when you buy a stock, you normally want to see two things. You'd like to see it if it's got a good-looking chart. You'd like to see that it looks like the trend is still higher. It's above the trend lines and moving averages. You want to see the stock trading above 1, maybe 1.04 or something like that. So it means it's outperforming the S&P 500 by at least 4%. If it's deteriorating, like a lot of these semiconductors probably are showing up, you can look at the broader market and look at the broader chart and see that, that whole sector was deteriorating. But if you have something where you come up here, like with the semis, where all of a sudden you had this 8 to 10% pullback, then all of a sudden you recover 5% in a week, I would say that's pretty good that was deteriorating, but it's probably oversold and we're on our way back up. If you're below 1, and say if you like a semiconductor or something that's say at 0.90 or something like that, it means it's underperforming the S&P 500 by 10%. You can look at that two ways. When I see something like that, I'll go into the smart chart and I look at the UD slope, which it goes out over 50 days. I want to see that up-down slope on the smart chart thing go from about 0.8 or 0.9 to about a 1.4, which means it's underperforming the Dow. But if I want to see the chart, let's say over in, this isn't a good example, but if you had, say if this was all sideways action right here, instead of going up like that, this was going sideways like that, and if we look down, and I saw this going up here, the accumulation distribution, that means to me, if this thing went sideways in this area right here, it's not making any headway, but underneath that flat line, investors are buying that. That means the smart money is getting ready they're getting ready for the breakout for when it goes to here and it breaks out. They've been buying it, and you're going to get that breakout. Then if you see the condition is improving, or you see the 50-day relative strength go from like 0.9 to 0.99 or something like that, and the line's going like this, then I'm going to go ahead and move on that, and that'll look good to me. I hope that helped with that. Okay, I don't see any more questions coming in. I've gone over 40 minutes. I apologize for going so long, but I hope you got something out of that. Now, next week, what I want to do is we're going to go over some of these sectors, especially the energy and the materials sector, and maybe back into technology. We're going to look at the industries again that are outperforming on this bounce from Yellen's testimony, and we're going to try to drill down and find some stock picks in those industries, especially in the materials and energy sectors that I think, and possibly even some of the metals and mining stocks that I think we can get a trade out going over for the next couple weeks. Okay, I appreciate you taking time out of your busy day to join me with this in this 40 minutes. I hope you got something out of that. If you have some questions, go ahead, feel free to contact me, and we'll talk to you next week. Thanks again.